Dear all, we would like to thank you for joining us for the 19th event in our MeDirect Talk series. MeDirect aims to make investment simple and accessible to all. That is why we strive to provide you with the information you need to make your financial decisions. Today, we have with us the team from Liontrust, a company that, as at the end of 2022, had a total of 36.8 billion in assets under management, of which 441 million are managed by the global fixed income team that are with us today. We'll now leave the floor to James Bedell, the head of international sales at Liontrust, who will be introducing the rest of the team and run us through the agenda for this evening.
Good evening, everybody. I hope you can hear me clearly. Here we go. My name is James. I'm responsible for Liontrust business outside of the UK, and I'm delighted to be joined this evening by Donald and Sharmin from our global fixed income team to speak to you about our global high yield product. I'd like to thank Ingrid and MeDirect for filling the room up. And before we actually start and I give you 2 minutes on who Liontrust is, a couple of administrative points. One of them being these risk slides, which I would kindly ask you to get your binoculars out and attempt to read. But these are important, and there is another one. And one other administrative point, which I wouldn't mind doing. I'm definitely not a social media influencer, but I'm going to take a selfie because you've all got nice smiling faces. So if you don't mind, let's have a big smile from everybody. Chin chin. There we go. Thank you. So I'm going to just remind some of you, because we were here in 2019 for the last time, live and direct, talking to you about this fund, and introduce to those of you who didn't see it last time, who is Liontrust Asset Management, very briefly. So we are a fully independent fund management company, headquartered in London. We have offices in Edinburgh, which is where Donald sits. Sharmin sits in London. And we have an office in Luxembourg, which is where I sit, which is where we manage our European business from. Liontrust is independent in every sense of the word. So independent in our investment management processes. So we have 7 fund management teams. Each team has its own independent process. So Donald and Sharmin have their own way of managing fixed income assets. The other teams do things very differently. It can even be in the same asset class, but it's with a different investment process. The idea being that we think a diversity of approaches to trying to create alpha is the best way to add value to clients' portfolios. And there's nowhere to hide at Liontrust, like there is in some very large fund management companies. If you can't produce the alpha as a fund manager, you ultimately will not survive within our corporate culture. Not that we're chopping fund managers all the time. We have very, very, very few fund manager departures. So a very long history of keeping fund management teams with us because they're very engaged in the business. And the next part I'm about to say is extremely important. All of our key fund managers are partners in the business. So we have a partnership structure which sits behind our London Stock Exchange listing. So everything is completely transparent. You can look us up on the internet. If you have access to Bloomberg, for example, you can see exactly what our balance sheet looks like, et cetera, et cetera. So very, very transparent approach to both managing your money and the way we manage our own business. And the other thing that is key with the independence of our fund management teams is that we do not have a chief investment officer. So there's no one person at the top of the firm saying that this is our view on interest rates, or this is our view on the yield curve, or this is our view on Latin American equity markets. Because we believe it's for our individual fund managers to take those decisions and to create alpha in the portfolios. So we're going to speak to you today about our high yield fund, which is a developed market product, primarily investing in the United States and in Europe. We do not hold any Maltese bonds, I'm afraid to say. We have a small understanding of the Maltese bond market, and we're happy to talk to you about that afterwards. But it's a very diversified product that Donald and Sharmin are going to show to you. Importantly, it is under the sustainability rules in Europe. It's an Article 8 fund, so there's a degree of sustainability. So investing in this fund, your money is actually doing some good. It's currently offering an extremely, we think, attractive yield given where we are in markets of 8.5% in euros. Donald is going to give you much more information on that. And then he will hand over to Sharmin towards the end to get into a specific stock example, because I think it's always nice when people come to talk to you about what they do to give you a real life example of why we invest behind a given company. I'm going to stop there, hand over to Donald. We're going to try and keep it short because we're obviously between you and the drinks outside. So it'll be a short pre-programmed Q&A at the end, because I think Ingrid sent out a message asking people to send questions. We got 2, so lucky for you, that will be very quick, we think. The other co-head of our fixed income team is managing the money as we speak in Edinburgh, so he couldn't come. But with the miracle of technology, he's about to speak to you. Sorry, and then it'll be Donald.
So we have a video recording of Phil's, and he will be giving his update to all of you within this video.
Good evening. Thank you very much for coming along to this MeDirect and Liontrust presentation. The next 5 minutes you'll get to hear from me talking very much about the macro backdrop with a focus on the US and the impending mild recession that we expect in the second half of this year. After that, you'll hear from the main event of Donald Phillips and Sharmin Rahman talking about the high-yield asset class. The mini-banking crisis of March, which saw 2 US banks fail and Credit Suisse fail in Europe and have to be rescued by UBS, will have important ramifications for the real economy around the world. I'll focus on the US here, partly due to the availability of data, but mainly due to the fact that it is still the driving force behind financial markets. Going into the crisis, this backdrop is very important. Consumption has been strong, but is starting to fade, with the most recent US GDP figures showing consumption growth of 1%. Inflation remains a sticky problem. Goods prices are having a temporary fillip up in Q1, but by Q2, Q3 should be disinflationary again. Shelter inflation, housing inflation, should be much lower by Q3, Q4. There are natural lags there. The sticky part has been core services inflation. And this is the part that we very much need to focus on and the central banks have been focusing on. There is a natural transmission mechanism between the financial street, Wall Street, and what's referred to as Main Street, the real economy. In my opinion, there are 4 main transmission mechanisms here. Firstly, there's confidence, both business confidence and consumer confidence. And the latest consumer confidence figures, taken in surveys that lasted during the crisis, seem remarkably benign. But that leads me on to the 2 other factors, the transmission mechanisms. Firstly, there's the amount of lending going on that banks can do. And we've seen deposit outflows from the system flowing into money market funds and out of US regional banks into the larger banks as people look for that flight to safety. They want their money back. That makes it harder for banks to lend, basically because they're always worried about will they be losing the next tranche of deposits, and it makes treasurers, CFOs reluctant to take on as much lending. That's the quantity of lending. Even more importantly, though, there is the price of lending. And the price of lending is all about lending standards. I'd like to quickly show you a chart here, and these are lending standards before the crisis happened. And you can already see for the January figures, there's a big increase, a big tightening in lending standards, making it harder for corporates of all sizes to borrow or more expensive. This survey is quarterly. Figures for April are due out in early May. Expect a further tightening still of lending standards. The market and the financial system is doing a lot of monetary tightening effectively now on behalf of the Federal Reserve. How much is quite hard to gauge, but the best way of looking at this is to see what Fed officials were saying before and after the crisis. In January, February, Fed officials on average were guiding to peak rates, terminal rates, being 5.5 to 5.75 in the States. In the latest dot plot, that plot that looks at where each of the voting members think rates are going to peak, we're back down to 5 to 5.25, or one more 25 basis point hike from now. So I would posit that the Fed officials are really saying the market tightening has been about 50 basis points, and that will help feed through and lead to lower peak rates in the US, as well as having a ripple effect around the world. The whole banking crisis, I think, has knocked about 0.5% of where peak rates will be in the US, and it has ripple effects around the world. This does mean that one should be looking to buy bond yields at lower levels than one previously anticipated. Translating this into positioning, in our strategic bond strategies, we continue to run with a strategic long duration position with currently 5.5 years of duration. That's above our 4.5 neutral, but within a 0 to 9 year range. We'd look to increase duration further if there's any setback as market turns its attention back away from the banking crisis, back towards that sticky inflation that the Fed is still looking to conquer. Feeding through into credit strategy, it's very much about buying bonds in companies that can weather the upcoming storm, that have a strong balance sheet and resilient business model. It is a good time to be making money out of bonds, but you have to be incredibly careful in your selection. Thank you for watching. I look forward to updating with our further thoughts in a month or so's time.
So I'm just going to talk really a bit more about the high yield bond market. Phil's given an indication there that it is our view that the US economy is going to probably move into some sort of recession in the second half of the year, maybe early next year. US still the sort of reserve currency, still probably arguably the most important economy in the world, and kind of if they catch a cold, everyone else sneezes kind of philosophy there. So how does that relate to the high yield bond market? Well, in terms of valuation, where are we today? So the chart there shows, on our left-hand side, the chart shows the yield of the global high yield bond market, which today is around about 9%. Now, we fixed income professionals like to split that yield up into two. We like to also talk about spreads. The spread is the component that you earn for lending to companies. And by splitting out in that way, we make comparisons between company valuations a bit more easy. So what we can see here, a yield of about 9%, that's above average over the long term. It may not stick out on this chart because of the huge spike in the global financial crisis in 2008-9. But we are today at a starting point, if you're investing today, of higher than average yields. The spread, the component we earn for lending to companies, is around about average in the long term. But as I'm going to get into more detail in the presentation, the higher quality end of the high yield bond market we think is actually very attractively valued at this point in time. That credit spread fundamentally is rewarding you for long-term default risk. For long-term investors, the only real way to lose money in the corporate bond market is through defaults. Now, you may lose money if you sell out at a lower price than you bought in, but if you're a long-term investor, the only real way to lose money is through defaults. So let's talk a bit about defaults. Here we go. On the left-hand side, we've got Moody's, one of the main credit rating agencies. Moody's expectations for the default rate in 2023. That is the base case is the blue line. Apologies if you can't see it, but Moody's are expecting defaults to increase to about 4.5% in 2023 in the high yield market. That is coming from a very low base. Defaults have been extremely low. Going up to 4.5% takes it in line with around about the average default rate through history. Of course, there may be more pessimistic outcomes, there may be better outcomes. We aren't overly pessimistic about what's to come. We actually think, although rising, the default rate is going to be reasonably manageable. On the right-hand side, just a little bit of a reminder about the different grades of quality within the high-yield bond market. What we can see using 100 years of data is the average default rate 1920 to 2020. You can see the AAAs and the AAs, the investment grade part of the market. It's almost bulletproof. It's a bit like the Maltese local bond market. And then as you can see, as you go down the rating scale to BB into B and then into CCC, the shape of the curve looks extremely different. Now that might be stating the obvious that you see more defaults in the lower quality part of the market, but I would posit that the behaviour of many of market participants going through the cycle, people forget about this dynamic that exists in the lowest quality parts of the market. And as we are going into a period where the economic outlook looks a little bit more uncertain, it's always important to remember the danger that exists in the lower quality parts of the market. Now, one that I mentioned that we are not overly pessimistic on defaults. One of the reasons we have that relative confidence is in the amount of debt that needs to be refinanced at a system-wide level. This shows you US market, the European market. That's where we do most of our shopping. This shows you the amount of debt that needs to be refinanced this year, 2024, 2025 and onwards. Basic point is, for everyone that can't maybe see this slide perfectly, the basic point is the next 2 or 3 years, there isn't that much debt to deal with. The problem is further out in the future. Because we've had such a good period for financial markets, most companies have pushed their debt out into the future. So when you have periods like this where markets become a little bit more stingy and it's more difficult to issue bonds, you're not going to see that system-wide increase in the default rate because there isn't a lot of refinancing to do. So that's one of the core reasons why we are actually reasonably optimistic on the default outlook for the market. Now, there's a lot going on in this slide, but hopefully it's just the colours that tell the story. So this table shows us how much spreads, so remember when I said spreads are the compensation for lending to companies, how much spreads are rewarding us for default risk in the market. On the right-hand side of this table, it shows you 5-year periods in history. So it's really useful to look at the high-yield market in 5-year periods because that's generally the length of the bonds that we lend to companies in the high-yield market. The very right-hand side shows average 5-year default rates. The next 2 columns, the very far right shows the worst, and the next 2 columns shows the average 5-year and worst 5-year default outcomes. Forget about the numbers though. On the left-hand side of the chart, we have European, US high yield, and we have different rating bands. If we look at BBs, in different recovery scenarios, a company goes bust, you do get some money back, okay, usually. BB bonds, the highest end, quality end of the higher market, you would expect to get a reasonably high recovery rate because they're good quality bonds. So in that 40% recovery rate for BBs, the no shading there on this table shows that we are being compensated for better than the worst ever period for defaults. So right now, BBs are compensating us for something worse than what happened in 2008-9. The lighter shading says that the market is compensating us for somewhere between average and the worst ever. So single Bs are compensating us enough for something worse than average, not quite the worst ever. And CCC's dark shading are not even compensating us for an average default environment. So if we think back at that chart I showed about 100 years data earlier about the danger within CCCs, today we're not even really being paid to take that risk. The best value in the high yield market is at the quality end of the spectrum, and that is where our fund invests. Camera there. Sweet. Now, this chart is a history of both the price return of the global high yield market and the total return of the high yield market. So what that means is the lower line strips out all the income, strips out all the interest payments that company makes. and just shows you the daily volatility of the high yield bond market with defaults. Over a very long time, that's a gradually declining line because defaults are a crystallization of capital loss. So you have that gradually declining lines with periods of volatility. But look at the top line. The higher line adds back the income, and it completely dwarfs that little bit of daily volatility you get, that default risk you get, because income is driving the returns in the high yield bond market, the company payments. So don't worry about daily volatility. Don't even worry about quarterly or 6-month volatility. Don't worry about what could happen in the second half of this year if a recession comes, because the income in the high yield asset class history has told us will save your capital and end up giving you a positive outcome. So I said at the start that we've got a roughly 9% yield in global high yield today. That's a roughly 5% spread. That is kind of similar to where we were at this time in 2008. Why 2008? There was a big recession coming in the second half of 2008. Similar valuation to today's starting point. What happened to someone who invested their money at the end of May 2008? Did they lose all their money? Did they have a horrible time? Not 12 months, but within 14 months, the investment that they'd made in May 2008 was back in the black, was back into positive territory. And in the calendar year of 2009, remember how grim everything felt on the 1st of January 2009? In the calendar year 2009, the high yield asset class made a 60% return. It's a resilient asset class, driven by income. Today's starting point is perfectly good, even with a recession coming. With that, so there's a quick run through of our idea of the macroeconomic backdrop and the valuation backdrop for the asset class. I'm going to hand over to Sharmin. She can talk a little bit more about us and how we do things.
So good evening all. As Donald mentioned, my name is Sharmin, and I'd like to go through the key characteristics of the Global High Yield Fund. Now, the first point I'd like to talk about is income. This is a very important point about the fund. Our fund currently yields 9.9% in dollar terms. Our fund is denominated in dollars. You're probably more interested in the euro share class. And in that share class, we yield 8.3%. We find that a very attractive level and a good entry point for investors. Secondly, I'd like to talk about our quality bias. So further to Donald's slides earlier, it's an area of the market that we feel is the best place to be. We feel it still offers value. So therefore, we have that quality bias. In our fund, we predominantly have double B and single B credits. We have some exposure to investment grade credits and less than 5% in triple C. Again, talking about our quality bias, that only accentuates that. We are index agnostic. What does that mean? It means that we are actively managing our portfolio. We only hold names that we're very comfortable with. And with regards to the index, if there's a particular sector that we're not comfortable with, or if there's a particular sector that we feel is a bit more sensitive to the economic environment, we will simply have zero holdings in that sector. We will not touch it. We're trying to reduce the drive of thematic risk. We want to avoid that. And we only hold names that we are truly comfortable with. And because of that investment approach, we actually run a very concentrated portfolio where we have limited issuers in terms that we're comfortable with, but we hold a higher weighting in, so 1.5% on average across holdings. The next point I'd like to make is the fact that we also run the research process, which we call PRISM, which I'll go on to my next slide, and I'll give you an example on that. We favor developed markets over EM. We feel with EM credit, there are specialists for that, and in developed markets, it still offers plenty of opportunities for us. We favor large, liquid, listed credits, mainly because with over small and private companies, mainly because of the access to information in terms of financials, news flow. It's much easier to keep on top of these sort of names. In terms of liquidity, it reduces our trading costs. It means that if we want to get our money back on a particular bond, it's easier to do. And the other point is that our overall long-term strategy is to outperform the index as well as our peers. Now I'll just move on to the next slide. So this is an example of our PRISM model. So what does PRISM stand for? Again, this is just a research example of a particular company we may consider to invest in. So PRISM stands for protections, which is basically how we look at the business, what are the key drivers of the business, if the bonds are linked to particular securities, where they sit in the capital structure. R stands for risks, so we evaluate the credit risk, market risk, as well as business risk. Interest costs, which is I, is shorthand for financials. We evaluate the financials. We look at earnings trajectories. We look at the amount of debt on the balance sheet. We look at the level of liquidity in the company, which is a very important point. S stands for sustainability. So we look at ESG factors affecting the environment, as well as other key stakeholders. And M stands for motivations, which is the motivations of management, as well as shareholders. So in this example, this is a company called SAPI. It's a South African paper and pulp company. It's a company that we've more recently invested in. It's rated double B, so very high quality. In terms of P, the business was previously a graphics paper company, but it's transitioned more to a global wood fiber business. So 50% of its business still is in graphics paper, which is, for example, they may produce things like those shiny, glossy leaflets that you get. Around 30% of the business is in packaging, which is very high margin, more stable part of the business. This is an area that SAPI are looking to expand further in, so that's a very good quality of the credit. 20% of the business is in dissolving wood pulp, which is a material that's used for viscose. Viscose is used in clothing. In terms of R, we'll say the key risks are probably the exposure to graphics paper. It's a market that's in structural decline, but where our concerns are mitigated to some extent is the fact that SAPI are actually openly trying to sell paper mills, so actively trying to reduce capacity in paper, and therefore having a balanced supply and demand dynamic. The other risk factor could be considered is the overcapacity in dissolving wood pulp part of their business. But as the material is used for viscose and therefore clothing, that's linked to GDP and population growth. Again, an area we feel that is not of huge concern right now and is heading in the right direction. Interest costs, which is short for financials. The company have a low level of net leverage, which is 0.9 times for a double B credit. That is basically the level of debt versus earnings. They have a target level to be below 2 times, which is very conservative for a double B credit. They have a good level of liquidity. So they have enough liquidity, enough cash on hand, enough cash in their banks to cover near-term maturities up until 2026. So for example, like one of Donald's slides, where the companies tend to have like all the near-term maturities and there's nothing to address up until 2026 for this credit. In terms of sustainability, the company is rated single A by MSCI. That's basically almost like an investment grade company on the credit spectrum equivalent. And in terms of motivations, the motivations of management is that they would like to reduce debt and improve earnings. Now, these could be just words you could say. Some management could just say that to please investors. But this company has been actively keeping to their word, and more recently with their cash and the cash they generate in their business, they've used that to tender for 2026 bonds, so to pay down some of their debt. And if a company is proving and keeping to their word, we take this quite positively. So taking all of those points into consideration about SAPI, this is a company that we're very comfortable with, and since investing in it, it's performed really well. This just gives you an example of how we look at candidates before making an investment decision and before it hits our portfolio. Now I'll just hand it over to Donald for closing remarks.
Thank you very much, Sharmin. So that is a really important slide, actually. I think fund managers given stock examples, it's like, okay, yeah, fine, you know the companies that you lend to well done. That's like the least you should be able to do. But what that prism hopefully shows is that we actually entrench the quality bias that we've talked about into the portfolio, because it's really hard to find companies in that lower quality part of the market that meet the characteristics that Sharmin was talking about. So it's really just like an entrenched quality bias that we have in our process. We never own much of the lower quality part of the market. So just to summarise, and everyone can get a glass of wine maybe after a couple of questions. As Phil touched on from his video, we think there is some sort of recession coming down the line. Our view is that it will be a mild to moderate recession. And in that outlook, interest rate increases are nearly done. We think that generally, for decent quality credit, is a reasonable backdrop. High yield, quality end of high yield is resilient, as hopefully we've persuaded you to some extent this evening. And even after the decent rally and performance of high yield bonds in the last 6 months, there is still decent value in the asset class. We talked about the Euro share class yield of 8.5%. I remember when I first started coming to Malta 5 years ago, we were talking about the fund yielding 3.5%, 4%. So more than double that, or around about double that today. But we still have those resilient characteristics. We're still very confident in the asset class. And with us, you get a highly experienced team and a high quality approach to high yield as an asset class. So with that, thanks very much for coming along to listen to us. James, are you delivering questions for Sharmin and I?
Yeah, I'll try and do this properly, unlike before. So we did get 2 questions, which have not been rigged. So it's, in essence, we've kind of answered this, but the first question is to do with that lower end of quality in the market, so the CCC area, and how much do you have, and your view on the defaults around that, and the management of your portfolio. And I'm not sure who wants to answer that, but...
Sure, yeah.
Take that, yeah. In terms of what we hold in CCC, again, it's below 5%. In terms of defaults, as kind of mentioned mainly in Donald's slides, defaults almost accelerates more as you go down the credit curve, which is understandable. With the higher quality part of the credit curve, that's where it still offers plenty of value. So I'd almost ask the question, why would you want to go further down the risk curve when you're already being offered a lot of value just in being in the higher quality part of the credit curve? So for example, our fund is 8.3% in yield and it has a high quality composition. So again, why would you want to go down the CCC area? If you're in an area where towards the end of the year, if we're entering into a mild recession, it's the CCCs that you'll see suffer the most. The sort of credits that we're invested in, yes, they might have to go through a turbulent period, but they're better equipped to go through such a turbulent period. They have stronger balance sheets, they have a lot more cash, they have a lot more liquidity in general, so they can weather the storm. So I would say that the better quality part of the index offers plenty of value and has strong fundamentals and can weather that storm. So that's the reason why we don't hold as much CCC.
We did have another question to do with the recent banking sector volatility and any impact on the strategy, basically with what's taking place in March.
Sure. So Phil touched on it. I'm sure you will all have read about SVB Bank, which is a US high yield bond issuer. Signature Bank, also in the US, and I mean, I don't know if you could possibly have missed what happened with Credit Suisse. So each of those companies, those banks, have been borrowers, large borrowers in the bond market. We didn't have any exposure to any of these organisations, but one of the really interesting things that occurred a few weeks ago was this part of the market that's called AT1. So it's a type of bond that banks issue that can absorb losses without the company actually having to default. So it's a form of capital rather than a form of funding. It's like equity, in other words. This was held in large swathes across fixed income managers in Europe. And what happened with Credit Suisse is, with UBS buying them, is that even though Credit Suisse remains a going concern, it's been bought by another company, it did not go bust. They wrote all of the entire amount of the Credit Suisse AT1 bond to zero instantly on a Sunday evening, and the market came in on a Monday morning to deal with that instant loss. So when I talked earlier about recoveries and default, and sometimes you might be happy to expect about 40% in the high yield market, this was a bond where you got nothing. And it had real implications for the value of all AT1. Now, in our high yield fund, we have only about 2.5% in AT1 from none of the aforementioned banks. So that's quite a low exposure. It's a low thematic exposure, because these are instruments that are all impacted in a similar fashion to an outside event. And in our fund, we try and minimize these thematic connected exposures. So something comes from left field, you don't find you have a massive hole in the portfolio. So we had about 2.5% in these AT1 bonds, but none from the aforementioned banks. And actually, you probably wouldn't have noticed that small impact on the price of those bonds on our daily price in the fund, whereas quite a few competitors couldn't say the same thing.
Thank you for joining us, and nice evening, everyone.
Thank you very much.